So I'll now hand over to Rahul. Thank you.
Year to it, what's happened, what's going to happen now. If you look at this, a bit of a surprise from where we started this year. We all were expecting US, Europe to do well. Japan was really something one had high hopes for. And if we see, we're done with about 8 months in the year, and if we see what happened is we've seen some of the laggards of last year, economies which got impacted last year, Indonesia, India, do extremely well. Positive election verdict is a reason for that, but a lot was to do with the fact that these economies put the house in order, the current account deficits went down considerably, central banks hike interest rates, slowed down the beast who were living beyond the means, consuming a bit too much, and consequently, despite tapering happening, the impact was very little. I mean, how surprised is the whole state of markets? You look at this early this year when we were meeting investors, meeting media, everybody was asking about tapering, and our view to people was that look, tapering is a event whose impact's been already felt in 2013, and markets are always forward looking. As the underline improves, we're not going to see a significant impact of tapering on India, Indonesia's two of the fragile, so-called fragile five who are in Asia. If you look at what's happening now, we've seen considerable improvement in the US economic data. Payrolls, but for the last time, have averaged above 200,000. But what's happened is we've seen Europe surprised negatively than before. A part of it can be attributed to what's happening in Russia. But I think what's also happening is somewhere the Chinese demand, the Chinese imports are impacting the demand, particularly in economies like Germany. What we believe is, despite this US recovery and a likely increase in US interest rates in 2015, the rise in US 10-year yields may not be that much, because it may be a question of the relative attractiveness against the paper investors have as an option to invest in the eurozone. And with dollar being strong, or dollar strength likely to remain for next 12 to 18 months, it's highly likely that yields behave a bit differently from what people expect. And what we believe is it's highly likely that you'll see QE happening, though on a limited basis, from ECB. And should things not improve in Japan, because second quarter GDP was a disappointment, BOJ also embarking on a second round of quantitative easing exercise. What does it mean for emerging markets? Have investors forgotten everything, and are they chasing junk? Again, a word about regional growth outlook, and just two things I'd like to highlight on this slide. That for equity investors, what is of paramount importance is demographics. And as I've kind of shared with some of you in my interactions, demographics backed by good governments creates the outlier effect, as said by Malcolm Gladwell. And that's what we are looking at. That's what we are actively watching from medium term allocations of our portfolio. Look at where demographics are favorable. Look at where the governments are doing the right things to make sure that these demographics actually remain a dividend by creating the jobs for all these youngsters in the economy. And another factor to keep into mind while looking at economies on a macro level is the household indebtedness. This is the reason why we've seen demand recovery yet to happen in Korea. This is the reason why we've seen some of the households in Taiwan, Singapore, or Malaysia still be stretched despite a bit of an economic recovery, because demographics are not that great and household indebtedness remains high. We look at the country outlooks. Again, we've got Korea and Taiwan, but before that, few words about China, which is really something of interest to everybody. If you look at China's market basically, or we've seen some bit of a rebound in market in last 3 months, pretty much from May lows, where almost everybody was universally bearish about markets. People were writing obituaries saying you're going to see hard landing, and our view then also was that one has to be reasonable with the expectations. We don't believe that growth is somewhere this 7.5 number. This is an artificially propped up number. We believe that true growth is closer to about 5.5, and the sooner the government realizes this, the better it is for all of us. As we talk to senior people in the government, in the party. The sense is that there is a bit of a difference in view in senior members of the government or the party. The intelligentsia believes that we should accept 5.5% growth and communicate to the masses at large that this is the quality growth, and we are today a 9 trillion economy and we've got to accept this growth. But at the same time, there's an old school which has made up the party ranks by just focusing on growth over the years, and it's hard for them to let go of this parameter of evaluating one's success progress within the party, which they've used over the years. So I think the sense is hopefully we see this disconnect getting resolved in coming years, and China kind of settling for a healthier 5.5% growth. A key parameter to look at this growth factor is again the credit intensity, and I think that parameter would be the key parameter for re-rating of the Chinese market. That should the credit growth be in line with the nominal GDP growth and the economy stabilizes around 5.5%, we would see market getting re-rated significantly, because we've always believed that markets trade the delta in ROE, and China's problem was capital allocation. Because money was cheap, the money was misallocated. But hopefully, as this money gets a bit tighter, and we've seen PBOC do that, they've maintained a tight liquidity bias for most months in this year. Money is utilized gainfully, is put in useful assets, and consequently the whole economy benefits from increase in productivity. We clearly again believe that hard landing is a unlikely scenario in China, despite all these talks of real estate price correction, a bit less in tier 1, tier 2 cities, 5-10%, 20-30% in tier 2, tier 3 cities, because the household debt, as you see on these initial slides, in China remains low. A lot of this debt is owned by locals. Fiscal deficit is still 2% of GDP. Current accounts surplus remains healthy. In fact, trade surplus for last 2 months for China has been to the extent of $50 billion. So I think the key thing is that one has to be positioned in right sectors in China. This is the economy in transition. Some sectors would be more negatively impacted than all. We clearly believe that the big bull market as commodities is over. China is going to move away from fixed investment to a consumption-led growth. But this is a slow, drawn-out process where they will control this fixed investment growth. But if things slow down a bit too much, relax on that, and again go back to tightening the fixed investment growth. So one has to be in right sectors, and those right sectors have to be consumption. Related to consumption would be healthcare, internet, mindful of valuations over there, travel, tourism, clean energy. A part of this desire for clean lifestyle would be clean, quality foods, quality consumer staples, companies with the strong market share brands focus on this. And we'll talk about this as we talk about the themes in the portfolio. Moving over to Korea and Taiwan, and there's been a lot of excitement about Korea in recent times. We've seen the Korean finance minister come and announce an incentive for the corporates to pay higher dividends. Markets rallied on that. But somewhere we've been a bit skeptical of the move. Our view was Korea is trying to do what Taiwan's done. And if you go meet corporates in Taiwan, most corporates would pay out nearly 50 to 80% of the profits. But the difference between Korea and Taiwan is that your profits payouts or dividend payouts get increased only when businesses see a stable outlook, and that's what's missing in Korea. It's an economy which is influenced too much by the chaebols or the biggies, and that's where we're seeing issues with Samsung, the leading smartphone manufacturer. Market share gains have been tough to come by the automakers. The construction of the shipbuilders and the petrochemical refining companies are facing competition from China, Middle East, and clearly you can see that in the economy where you're not going to see, or you're not seeing, significant wage increases, where the feel good is missing. Despite a bit of a global recovery, we've seen exports not growing much. There is a current account surplus, which is a function of lower imports much more than anything, indicating weak consumption demand. So clearly all these factors which we talked about in the past are playing in terms of poor demographics, high household debt weighing on consumption. What we like on Korea is remain same. We like the soft intellectual power of Korea. We clearly believe that there's a lot of good work in the economy, which is in terms of companies like Naver, which have brands or social networking sites like Nine, which is also kind of a developing as a mobile platform with more than 400 million users. We like Korean brands, consumer brands like Orion, Amora Pacific, Hotel Sheila, the beneficiaries of travel and tourism, the Chinese tourists liking the Korean soaps drama, and Korea as a place to visit to. Taiwan continues to be underweight, and again, it's something which has not worked for last 6 to 9 months for us. Our view remains same despite the near-term bounce in the economy, largely on back of the wealth effect, largely on back of the strong exports. We believe that this is short-lived and it's going to kind of a give way in next couple of quarters because same demographics, indebtedness issues remain. In technology, again, we've kind of visited Taiwan nearly 2 to 3 times in last 6 9 months, and our view is there is an absence of the next killer apps beyond iPhones, iWatches. You're seeing smartphone getting commoditized very quickly, and because the whole smartphone market is shifting to China, where these Chinese white label manufacturers are gaining significant economies of scale through market share gains in India or other emerging markets, you're seeing Taiwan component industry, IT component industry, getting commoditized a lot more faster than one thought. So one is really reluctant to pay 15 to 17 times 1 year forward for these companies, and we are looking to look at some of these names in China which are good scalable. And an example is, rather than look at a Taiwanese lens maker, we've looked at a Chinese lens maker which is going to benefit from, again, all the camera modules becoming compulsory in automobiles in US by 2018, which is going to benefit from a new feature which is introduced in iPhone 6, which is your image control, optical image stabilization, a number of all things. But we would be biased towards the IT component maker in China because that's where the industry is moving to, which is an exciting story, something which is done well, and fairly happy with our call over there. We've been overweight that market all along until April this year through exporters. As we got confidence on the domestic recovery, we added names like Maruti Suzuki over there. We added names in banks, industrials over there, and something's worked. So not only have our exporters IT focus worked well, exporters largely pharmaceuticals and IT software companies worked well, but also the domestic cyclicals have done well. So India would be close to about 22-23% of the portfolio, and we remain extremely confident on that despite the near-term run-up in the markets, because we believe that at inflection points, price earnings ratio is a poor indicator. In bull markets, when you look at P, things look cheap, but what one misses is that your profitability, which is corporate profits as a percentage of GDP, are record high, market cap to GDP are record high, so you maxed out. Whereas when the markets turn, when the economies turn around, which is the situation now, one very often tends to underestimate the strength of the recovery. Like if you look on slide 9, you look at the operating margins or the EBITDA margins, and those numbers are record low. And our view is, as the recovery gets firmly entrenched, feeds through the whole economy, it's highly likely that you'll see massive earning upgrades. And a perspective to share over there is, corporate's profit as a percentage of GDP were 8% in 2008, when the market cap to GDP was 120%, and today the same corporate profits as a percentage of GDP are 4% when the market cap to GDP is 80%. So that's really the idiosyncrasies of market. When everything is rosy, they'll give you a top multiple, and when things are not so good, the multiples are lower. So I think that's a perspective to keep in mind. But let's look at what's happening on ground. Is Mr. Modi's halo working? Is he really doing things on ground? Or I mean, what is happening in reality? What is the expectations from this government? Clearly, I think what he's done is he's taking care of the low-hanging fruit, which is told the bureaucracy to work, clear the projects which were stuck, and that is the first thing to get the momentum in place. So you're seeing economic momentum back in place. The second quarter GDP surprised positively at 5.7%. You're seeing auto sales improve. You've seen cement sales improve, and what he's doing is now laying the building blocks for the next round of recovery, which needs to come on back of a strong, significant jump in FDI in the economy, which is where you see Modi going to Japan. There is a trip which is lined from the Chinese Premier next week. He's going to meet Obama in September. So all these things do is make India an attractive investment destination. We've always maintained that the single biggest factor to be seen for India's growth is the trade deficit. Because the economy is inherently consumption linked, 60% of the economy is linked to consumption. Invariably, as the economy bounces back, is the rising trade deficit which is going to limit the GDP recovery or limit the ability of economy to grow at 7 to 8% consistently. So what we need to see is a significant jump in FDI from 25 billion to a 50 billion for the economy to do a 7 to 8%. So that's what this act of the Prime Minister does, meeting all the states, making sure you get large scale FDI in the economy, so that till the time the productivity plays through, which is 2 years from now, which can take care of the currency, you have significant FDI which manages the rising trade deficits. On ground, clearly, though the big bang reforms haven't really happened, but things are moving, and it is expected that in next 12 to 18 months you'll have things like GST, you'll have UID, which is your unique ID, to make sure that some of these wasteful subsidies are reduced. Included financial inclusion plan for 75 million households is extremely positive. Focus on infrastructure is going to happen. So things are moving on ground, which is why I remain extremely positive. And we believe, like we've said, that India remains a multi-year story. Markets move too quickly for comfort. People have not got chance to enter the market. What's also happening is locals who were selling for last 2 years are now buying into the market. We've seen domestic inflows to the extent of about $5 billion. So which is why dips are going to be short-lived. So what we're asking our investors is that look at this market from a medium to a longer term perspective. And we clearly believe that returns from a 2 to 3 year perspective are going to be fairly superior, because earnings growth rate are close to 18 to 20% for a 16 to 17 times earnings. We come to ASEAN, which is something which has been close to our heart. Unfortunately, we're seeing the region go through a breather, a correction. The coup in Thailand hasn't really helped the cause. And like the way we communicated to you all early this year, we believe that the status quo, which is the current status quo of military in power, remains longer than most people expected. Because the view clearly there was that somewhere you erode PO Thai parties' large up-country population base. What it does is impacts the investment in the economy. You can see a bit of a consumption recovery, but not a significant recovery. The markets have run up largely on account of local flows, but the confidence there remains limited. We continue to like Philippines. The only issue there remains is it's a small market. You can't have more than 4 to 5% weight over there, but the economy is in good shape on back of large service-led remittances, inflows, again a large young English-speaking population. What's interesting at this point of time is Indonesia. The election verdict is clearly positive. Jokowi is like Modi in his approach, commonsensical approach to governance. What is different is going to be, again, unlike Modi, he doesn't enjoy that large extent of support. So it's going to be an uphill task for him in the coming quarters to put the economy in shape, which is reduce fuel subsidies, attract investments in the economy, and attract the FDI. But we believe that next 12 to 18 months would offer good entry point in Indonesia. We've got 5 to 6%. We are already overweight quality companies, but we think we would like to increase our exposure in Indonesia as we get confidence in Jokowi's ability to move away from commodity-led exports. Why we've liked Indonesia is what you see on the charts in front of you on slide 11, where we've said that oligopolies are equity holders' delight. Coming back to our old tenet of investing, given a choice between a 9% GDP economy with low entry barriers and a 6% GDP economy with high entry barriers, you will go for the later. Because oligopolies give you high profitability, high ROEs, they are equity holders' delight. And that's what Indonesia is all about, which is where we like the market. It's just that we are looking for good entry points in stocks we like to increase our exposure over there. A key factor to be watched would be FDI in manufacturing. It's a focus area for the government, and this is the way they'll bridge their trade deficit, which is bound to rise as the economy bounces back, consumption increases. I again reiterate something which I've been sharing with you all for close to last 1.5, 2 years. The end of the commodity super cycle. What we saw in commodities was unprecedented between 2004 and 2011. What we are seeing is entirely opposite. You're seeing new supply coming on stream. The marginal costing for the BHP Rios of the world in iron ore is $35, $40. They still make a lot of money at $80, which is why you'll see iron ore coming down. And I think that's a trend which is likely to happen. And a similar thing would happen across other commodities. Crude oil is an example where we're seeing Saudis, in order to retain their market share, come back and aggressively discount for future deliveries, and which is why, to everybody's surprise, today we see oil at $100 per barrel. One is hearing stories of Chinese circumventing the export ban in aluminum by exporting rolled products, which can be subsequently melted into plain hot metal later on. So all these things are happening, and clearly we've seen increase in exports in China for steel also, because it's a lot more competitive for them at current iron ore prices to make steel in China and then export to the world. So our view remains same. The big bull market in commodities is over. You'll see very little exposure to commodities in our portfolio. Consequently, we remain negative on industrials also, because we believe that large part of our industrial order book is constituted or comes from the commodity-led capex. We come to the valuation paradigm, essentially. More of a reflection of what we've done for the year, where are we, and that's where we see that MSCI Asia has gained close to about 10% vis-a-vis a 9% gain for S&P 500. And what's happened is that it's now that you're seeing domestic investors getting excited, and I'll talk about that in a minute from now. But for long, international investors been underweight the region. People been happy in US, Europe, or Japan. Europe and Japan is disappointed. US looks fairly valued. And as investors get more confidence of a profit or a growth recovery in the region, it is highly likely that a lot of medium term and a long term money is going to chase the region. If we go back to our argument 3 to 5 years back, our issue with the region, Asian region, was that we like the region from demographics perspective, but valuations are too expensive. And for last 3 to 5 years, because of the earnings cuts, a typical down cycle which happens in the region, what we saw was investors leaving the region. Today, when the valuations are reasonable, we get a counter argument that where is the growth? So for those investors, I would urge you to look at performance of world versus Asia, which is the chart on bottom left on slide 13. And that's what shows that Asia, being a high growth market, is fairly cyclical. What happens is you go through these periods when the output gap turns negative, there is inflation, central banks come, slam the brakes. And because the market, like the 2008 India example I gave you, trades at a high valuation, you see P's contract for that market. So typically the best time for buying the region is after a period of underperformance. And that's where we have now. The region's kind of considerably underperformed over last 5 to 6 years, given only 17% return vis-a-vis a 33% for MSCI World. We look at valuations, again remain one standard deviation below mean. Discount to world remain high. To add a point over here is, even for a market like India, India's always traded at a premium to MSCI World. In the past, in last 6-9 months, the market went at a discount, and now it is at a par, virtually no premium. So clearly, as growth comes, as ROE comes, you'll see a lot more investors chasing it, which is why you'll see a bit of an excesses happening in emerging markets on both sides. And this is the slide for that. You look at the valuation paradigm. I mean, ownership of equities remain very low across the region. For China, this number is 6 to 7%. For India, this number is 4 to 5%. If we see ownership of equities as a percentage of financial assets, and we've taken India as a case study, at 08, at the peak of the market, was 13% and came down all the way. People got sick and tired of stocks not performing, moving into real estate, gold. And now in last 3 months, we've seen, as the headlines have become more positive, as they see signs of recovery, people put in close to about $4.5–5 billion in the local mutual funds in the Indian market. So that's what the chart on the left shows, which is the cumulative flows. FIs tend to take a much more longer term view, which is where you see the flows in India, Taiwan and Korea over last kind of 2 years, whereas locals are moved by whatever they hear in terms of near-term noise, coverage in media, and consequently they are not the good indicators of where the market or the economy is heading. And we believe that today we've reached an inflection point where locals are looking to increase their allocations in the market. It's happened in India. In China, there are press reports of government pushing the locals to actively look at markets, and we may see some bit of a tax incentives for insurance investments, mandating again some of the local pension funds to invest in equities, because they want locals to shift away from having real estate as a key part of their asset mix. A last slide on valuations before we move to the themes, which is something which makes us all excited, including me. Valuations remain fairly reasonable. Earnings revision, which is what moves the market, is clearly improved. We see that happening for the region, and consequently is what we see MSCI Asia's performance versus the world, which is seeing a significant uptick. And for those who are new to the chart, I'll just spend 1 minute over here on this earnings revision chart. The point to be taken is, or notice, is December 2010, when nothing could go wrong for the region. We had earnings revision which was extremely positive, but like the way we've kind of discussed before, the high growth region being Asia is fairly cyclical, and 2010 people were negative US, positive region, but what happened was that economy was at the peak, went through a cyclical downturn, and consequently the cyclical downturn, which was reflecting in the gray line, which is the earnings revision, was followed by the market movement or relative market performance of Asia versus world, which was the blue line. And today, as you see, this earnings revision kind of a bottomed out. You've seen blue line turn upwards or turn positive. So that is the point to be kept in mind, that markets trade the delta. If we feel comfortable about our outlook, it is there in the price. So it's really a question of, can things improve from now? Can earnings upgrades happen now? In terms of portfolio positioning, we continue to remain overweight India. A large part of our India exposure would be through quality exporters. We've added 2 domestic cyclicals, but like the way we've said, we never do a double beta. A double beta would be overweight a market and then go down the curve to get the extra meat. So we would not do that. It's a fairly well managed, well risked portfolio on this. We remain overweight Hong Kong, China, largely through Hong Kong, and large exposure would be consumption related plays, very limited exposure to industrials. We'll be underweight Chinese banks. Exposure to internet would be to the extent of about 4 to 5% through Tencent, Baidu. Can talk about Alibaba in the questions as we move on. And we remain overweight Philippines, Indonesia. Underweight would be Korea, Taiwan, Malaysia and Thailand. And that's something we've maintained in last 1 year. Going to themes, which is something which is very close to our heart, and as Ashley, my marketing head, says, that always kind of lights me up because I like quoting my examples over there. We continue to believe that the aspirational consumer is here to stay, and I see that every day in the marketplace. I think the joy of investing is you go around, observe consumers. So not only handbags, but you look at world outside handbags. And once you see what consumer is buying, you get more confidence of the story you believe, of the company's themes you believe are going to work for next 3 to 5 years. And that's where we come to a powerful theme, which is slide 19 for you all, the outbound travel. We looked at this and we clearly believe that we were about to reach the hockey stick in the Chinese outbound tourism, where we've seen nearly 100 million Chinese travel outside, and this number is expected to go to 200 million by 2020. And the way it happens is, we've seen that in Japan in past, Taiwan, Korea in past. When the economy hits $8,000 per capita, you have a hockey stick or a J-curve explosion which happens. Today in China, you've got 500 million people hitting that number. Just to put things in perspective, Japan's population is 130 million. So what you've done is created 4 Japans, or nearly 4 Japans, and this number goes to about 1.2 billion by 2020. And we're not talk of Indians till now. And this is the reason when we go around, see the world, we see Chinese all around because the sheer numbers are huge. And to put things in perspective, I'll just go back to one of our favorite examples. You go back to 1700s, 1725, 1730s. India and China were 35% of the world GDP. And then you had the Industrial Revolution, and obviously we saw the rise of the West. But today, when technology is available to all through multinational corporations, demographics and governance is going to determine how economies shape up, how economies grow in years to come. And that's why we remain very bullish on the Asian story, which is home to nearly 50% of the world's population. We talk about gaming, which is a segment which did well for us in past, but is going through a soft patch this year. And this is just to reiterate the same thing which we've seen, that nothing moves linearly in a very linear way. Even the most powerful trends take a breather. Gaming's been taking a breather because minimum bets went up too much in a short period of time. Hotel supply is limited. As new supply comes next year through properties in Galaxy, Melkokram, we're going to see things significantly improve. What have we done with the gaming exposure? Pruned in a bit, but still fairly significant for the portfolios, and we are happy to hold on because these are good cash machines, and we clearly believe that the potential for the segment is much, much larger. Something which has worked well for us this year and over the years is our exposure to local multinational corporations. To give you an example, this would be something like a Mirae Pacific, which is Asia's own Estee Lauder, gaining from this Chinese love for everything Korean food, Korean pop, and the Korean cosmetics. And I must say these products are good. So would urge you to try for yourselves, your spouses at any of the airports in Asia, Laneige products or Sulwhasu's products, fairly reasonable, good quality products. And that's where these names are doing well. So Mirae Pacific's done well because the Asian business, which was growing at 50%, 25% of the revenues, has broken even this year and is likely to go to company's average level profitability of 13% in coming years. Something which has also done well for us over the years is Universal Rubina. We first bought the stock where it was 50 peso, and today in a period of about 2 years it's about 175 peso, close to about 3.5 times, and largely happening because the company is given impeccable execution in the mid-end snacking, again beverages market in Philippines, and extended the franchise outside Philippines and rest of the ASEAN economies like Indonesia, Thailand, etc. And we're looking to do more of this across the region. So Orion remains a play over there, Godrej Consumer remains a play over there. Healthcare is something which is very close to our heart, and you'll see us talking a lot about this. Why we like this is because this is where active fund management comes really into play. We've got names like Lupin, we've been a 5-bagger for us, first bought into our India funds and now in the regional funds. And the best thing for us is healthcare has got a very limited weight in benchmarks. Unlike internet, which is somewhat represented in the benchmark. I mean, you can't see too many healthcare names. Most of the regional MSCI Asia benchmark would have very little healthcare names. AP would have more skew towards Australia. And I think that's where good quality bottom-up stock picking comes. And what we've done is identified the segments which are the most profitable, which is your chronic therapy segments, which is respiratory, oncology, again some of the neurology segments where companies make a lot of money, where the patient is sticky, and try to find winners. In India, Lupin, Glenmark, Osan. In China, would be something like a Liyue, a recent listing, or a Sion Pharma. In the past, we've been skeptical of Chinese pharmaceutical names because though China is the second largest pharma market in the world with 40 billion in terms of revenues, it is a tender-driven market. In a tender-driven market, you tend to lose your price competitiveness very easily. Price erosions are frequent. Consequently, you want companies with some bit of a patent protections, and that's what these two companies have. And that's where you will see in coming quarters in our portfolios, we've already built a position in these names. They've done well also post that, but significant weights in these names. An added opportunity is a large patent expiry in US, where we're seeing close to about $125 billion of patents going off patent in US, of drugs going off patent in US between 2012 and 17. In fact, India remains the prime beneficiary of that, with the highest number of US FDA approved plants outside US. A quick 2 minutes on rest of the slides before I open it for the questions. Smartphone. We're seeing the Asian consumer bypass PCs to access internet through the smartphones. We've seen rise in China. We've seen rise in India on back of that. And what's that's to is social networking sites, a big explosive growth where in no time, and 3 years is a short time in corporate history, we've seen Tencent build a WeChat franchise with close to 400, 450 million users. Never do the same with Line with another 500 million users. And today we have Alibaba's listing happening with likely kind of a market cap anywhere between 160 to 200 billion. And what's surprising is you've seen Alibaba's revenue go up close to 5 times in last 3 to 4 years. So they've got close to about 200 million active users. Gross margins are 75%. EBITDA margins are close to 55%. So that's what an interesting opportunity which comes. And what is a point to keep in mind is that close to 60% of the sales for Alibaba comes from tier 2, tier 3 cities. So what these social networking sites do is basically transcend the distribution barriers or handicaps large economies had. Quickly talking of food safety, and this is something, again, we had Mangnu in our portfolios in the past. Once we got confidence on the brands, enough quality checks they were doing, and the discerning shift which was coming in Chinese consumer taste towards branded products, higher value added products. We've also added WH Group, which is a pork manufacturer, in our portfolios in recent times. To put things in perspective, top 5 pork players in China have less than 10% share, whereas this number is 75% in something like US. We're going to see Chinese consumer move towards quality, pay a premium for quality products, and I think that is going to benefit these names a lot. So the point here I'm trying to highlight is the challenges remain in plenty with the Chinese economy. You'll see banks be range bound, but at the same time there are plenty of growth opportunities in secular sectors, whether it's again branded foods, whether it's healthcare, some of the internet names, where investors can make a lot of money because the underlying population subset is large. A cleaner China is something we have shared with you all before. The need for clean air, clean water in China. There is an increasing talk that one would be happy with a 5% GDP growth, but more higher quality growth. And that's where gas or water waste management companies remain a multi-year play. And our last theme is retail credit and insurance. Again, on one end of the spectrum is rich people or relatively prosperous people who want to save money for their kids' education, for their own retirements, and in developed markets like Singapore, Hong Kong, some of the upper middle classes, higher middle classes in ASEAN economies, China, where AI is a prime beneficiary of that. Life insurance premium versus GDP per capita remain a fraction of what you see in developed economies. On the other hand, you have young population in India, again, in ASEAN economies like Indonesia, Thailand, which straight out of college want to buy their first house, cars, which is where a HDFC Bank or a Bank Mandiri is a place. So clearly, we remain confident in these stories. The portfolio is done well for this year, and we remain confident that even if the economy, which is Chinese economy, slows down a bit, our portfolio should continue to do well. And I think in next 12 to 18 months, you would see better performance from the funds. I leave the floor open for questions.